Hi there. This is Bob Graham with Riggs Asset Management Company. Today we're going to talk about, how the events that are happening in the Middle East are affecting the economy and our portfolios. Where do we think we are at this moment? And as we enter the new quarter, what do we think for this quarter and for the remainder of this year? Let me start off and say, given the volatility that we saw last quarter, uh, you know, your portfolios did well, as you can see from your statements, which you should be receiving now. It was a bumpy ride, uh, but all in all, we went through and we managed that process, quite frankly, pretty well. And I think we're going to continue to manage well as we move forward. So, what do we see and what are the big issues? Number one, the single biggest issue right now is what's going on with the oil markets. And we'll put up a chart so you can see where we are today and what the futures or the futures of trading futures think it's going to look like as we move forward. Really, a couple things we can pull from this chart. One is that clearly the price of oil is elevated, but most importantly, when you look at the way the curve is structured, at least the market participants expect that once hostilities end, that the price of both Brent and West Texas Intermediate crude, which is what we have charted here, should come down rather quickly. Once it comes down from that initial drop-off, it's kind of flatten out and then gradually go down, probably for the next 2 to 3 years. Expectations are that Brent, the crude oil that comes out of the North Sea around, Norway, Scotland, that area, probably ends up a little bit below $80 a barrel. While here in the United States, our primary crude probably ends up at around $60 a barrel, give or take. Unfortunately, it's going to take a while to get there. And in the meantime, we probably are going to be experiencing higher costs and higher inflation. It will moderate as time goes by, but I think that's an economic reality that we're simply going to have to deal with, both in the economy and in the way we manage portfolios. Part two of that is, how does this movement in energy prices affect the markets? So the first market I tend to look at in any type of volatile period is the bond market. And the really interesting thing is, very, very recently, what's happened is we had a spike in oil prices. And while bond yields, moved up a little bit, they then came right back down and actually ended up lower than they were, let's say, a day, 2, 3, 4 days ago, a couple of weeks ago. So we're actually seeing for the first time a disconnect between oil volatility and bond market volatility. We take this as a good sign, an early sign, but a good sign. So from the bond market perspective, it looks like it's beginning to look through what's going on in the Middle East right now. So typically the bond market flows into the stock market. And what are we seeing there? Well, interestingly enough, over the last several days, we've seen the equally weighted S&P 500. So there's 500 companies in the S&P stock index. It is typically driven by the largest 7 or 10 names in that index. So, and they're all the names you know. They're the NVIDIAs of the world, the Apples of the world, the Googles of the world, etc., all the way, and they make up about 40% of that total index. Well, what's interesting is that the S&P index cap weighted is still kind of below its 200-day moving average. It looks like it's improving, but it hasn't quite recovered. While the equally weighted index has, and it's moved back above its 200-day moving index. A little wonky, I know, but this is what it really means. If you take all 500 stocks and you weight them equally, we're seeing improvements across the market. It's early, but we're seeing improvements across the markets. The largest companies are not moving up as quickly as some of the smaller companies in that index. That's not abnormal, but it does say that when you're looking at, where should we be right now? What are we looking at? We're not necessarily looking at the biggest names, the biggest companies. right now, many of the mid-tier large companies are doing really well. And as we look even further through and say, look at, say, small cap companies. So if we look at the S&P small cap index, it's actually given a short-term or near-term buy signal. So it's really the equally weighted and small caps are the first two broader indices in the stock market that we follow that have improved. What do all of these things tell us? Well, basically what it says is that it's likely we are beginning a bottoming process. This process can take several weeks, perhaps longer. It wouldn't be surprising to see the markets pull back again. But what would be interesting to see is each time we get a pullback, each time we see a little volatility, we see less and less companies going down and more companies going up. It's working through a process. And it looks like right now we've begun that process of bottoming. So what are we watching? Well, we're certainly watching the price of oil. We're certainly watching what's going on in the bond market. And we're also watching what's going on in the stock market. Just like last April, we saw a huge spike in VIX, which is the stock market fear index, pop up and then pull back. We saw a smaller spike in VIX this time, the stock market fear index, but it's now pulling back. And again, we're seeing that index in sort of the moderate high range for volatility. Again, it looks like we could be getting a bottoming process. So as we work through, what are we doing? Well, we're saying, okay, it looks like it's a bottoming process. What is that likely going to look like? Are we going to see it kind of just bounce around here? Going to see it go up and down and maybe retest the lows? All of those are possibilities, but it also says that you're going to begin to see certain areas outperform. And when you do that, you want to take advantage of those opportunities. And we are very discriminately going through and looking at areas of pockets where we see opportunity and beginning to take advantage of those opportunities. We're still very concerned about the risk side, and we will take actions to mitigate that. But all in all, it looks like while oil remains high and volatile, looks like the bond market's begun to disconnect from that a little bit. That's a positive. Looks like the stock market, we're going to see trends in both small cap and equally weighted indices that are improving. And all in all, it looks like we're entering a bottoming process. So as we work through and we work into this coming quarter, it wouldn't surprise us to see, maybe markets begin to move higher mid-April, latter part of April, into May, June, July, August. That would be pretty typical, normal patterns for an election year like we're in today. And then, we'll see what happens as we get into late summer. But all in all, our expectations are from the beginning of this year that it was going to be a very bumpy year. We thought we'd see at least one correction, if not two, one in the spring, one in the fall as we get closer to the election. But at the end of the year, our expectations were we'd see the stock market, 8 to 12% higher than we started. I think we can probably still get there. The difference is with the indices low, when you buy today, that 8 to 12% year-end price target from today looks more like 15 to 20% from here. So from a market's perspective, we think we're in a good position. We're taking advantage of opportunities when they see them. The key is what's going to happen with oil prices. Do we continue to see the bond market improve? Do we continue to see the stock market improve? And if so, it's likely that we're in this bottoming process and we could be in for a really good quarter and we think a decent full year. Anyway, if you have questions about this video or anything else, please reach out to your Riggs team member. We're here to help you in any way we can. Thank you very much.